It is 5:52 a.m. The elevator opens onto a floor that smells like recycled air and yesterday's lunch. Your badge says analyst, first year. You have $87,000 in student debt and a signing bonus that disappeared into your first month's rent in a city that treats your salary as a rounding error. You are 22 years old. You are here because you believe this is where serious people go. Your desk has 3 monitors. One runs Bloomberg. One runs your models. One runs whatever the associate texted you to fix at 11:47 last night. The fix was wrong. You fixed the fix at 1:14 a.m. Nobody confirmed receipt. Your first real task is formatting a pitch book for a client whose name you are not allowed to say out loud in the elevator. The client is a $430 million specialty chemicals company. You will never meet them. You will spend 11 hours making sure the font on page 47 matches the font on page 46. This is not a metaphor. This is Tuesday. The first rule arrives in week 3, delivered by a third-year analyst over bad coffee in the 38th floor kitchen. The work you're doing isn't the job. The job is demonstrating you can do the work without being told twice. Everything else is audition. You stay until a.m. because the associate stayed until a.m. You stay till a.m. because the VP called it midnight with changes. You learn to sleep in 90-minute intervals. You learn to eat at your desk without looking at the food. You learn that the organizational chart is not the hierarchy. The hierarchy is who calls whom and at what hour, and whether the call gets answered. One night, pulling data for a leveraged buyout model you don't fully understand, you feel the edges of something. Not the deal, something behind the deal. A set of incentives, relationships, and capital flows that predates the transaction by years and will continue long after the closing dinner. You can't name it. You file the feeling away. The market opens in 4 minutes. You haven't been home. You manage analysts now. You are the person responsible for the mistakes you used to make. You came up through 2 years on the desk, or you came laterally from a top 10 MBA program. Either way, you are 26 or 27 years old, earning $225,000 in total compensation, and you are newly responsible for the quality of work you used to produce at a.m. in a fog of exhaustion. The difference is that when the associate checks the analyst's work wrong, the VP sees it. You are the filter. The filter is now you. The currency here is output, not your output. Theirs. You are graded on what your analysts deliver, which means you are graded on how precisely you can translate a VP's incomplete instructions into a specific, executable task for someone who doesn't yet know what they don't know. This is harder than it sounds. The scene: 14th floor conference room, Tuesday in November. You are presenting a preliminary valuation to the VP and the client's CFO. The CFO is 52. He has done this before. He watches your EBITDA margin assumptions with the patience of someone who has caught associates in this exact error before. He is not watching to help you. He is watching to locate the seam between what you know and what you're performing. You find the seam before he does. You correct the assumption. You do not explain why it was wrong. You move on. This is the correct behavior. The VP notes it, not with praise. With the absence of a correction, a deal closes. $620 million acquisition of a mid-market logistics firm. Your name is not on the tombstone. The tombstone doesn't have associate names. You know what a tombstone without your name is worth. Nothing to the market, something to your resume, and exactly the proof you need that you can execute. Your social life narrows. This is not a complaint. It is a structural fact. The people outside finance don't understand why you can't commit to Saturday, and you've stopped explaining it in terms they'd accept. You start sorting conversations by whether they're going to cost you energy you don't have. Most are. The rule at this level: discretion is the only currency that compounds. The analyst who complained about the deal process is still an analyst. You aren't. You're the bank's face now, not the senior face, the working face, the one in the room when the MD can't be, which is most of the time, which means you are in the room more than anyone with more power and less to prove. You are 31, maybe 33. You're Base is $350,000. Your bonus depends on what the MD says about you to the group head, which depends on how the clients feel about you, which depends on something that isn't fully in your control and never will be. The currency shifts. It's no longer hours or output. It's relationships, not your own, not yet, but the bank's relationships, which you are temporarily custodizing. You manage the connection between the MD's Rolodex and the execution team below. You translate between vision and task, between client anxiety and banker reassurance. You speak both languages without an accent. Here is what no one writes in the training materials. A client relationship is trust borrowed against your institution's balance sheet. The client doesn't fully trust you. They trust the bank. You are what the bank sends when it can't send itself. You're in Singapore on a Thursday. The room is a hotel suite on the 42nd floor. There is a Southeast Asian conglomerate considering a $780 million cross-border acquisition. The CFO is polite in the way that people are polite when they already know the answer and are waiting for you to catch up. You catch up. You spend 4 hours walking through the regulatory overlay, the financing structure, the timeline risk. At no point do you say the word problem. You say consideration. You say complexity. You say the bank is well positioned to navigate. The company's workforce in the target country numbers 3,400. The post-acquisition integration plan projects headcount reduction of approximately 18%. You don't say this either. You say efficiency realization. The CFO nods. He's heard this before, in other rooms, with other banks. This is not a difficult conversation. It is a practiced one. You tell yourself this is the structure of how capital moves. You're correct. Your trust circle is now 8 people. 3 are at the bank. 2 are former colleagues. 3 are clients who call you specifically, not the bank's main line. Those 3 calls are the beginning of something, though you don't know yet what to call it. The rule, the client experience is the product. Everything else is infrastructure. You originate now, not formally, not yet. That belongs to the MDs. But you call CEOs. You have coffee with CFOs at conferences, and the conversation is not a pitch. It is a relationship maintenance exercise that might become a pitch in 18 months. If the company's strategic situation shifts in a direction you've already modeled out, you are not waiting for opportunities. You are creating the conditions under which opportunities recognize themselves. You are 37. Your compensation is approaching $700,000 in a good year. Your Rolodex is real now, built over a decade of transactions closed and relationships banked. Here is what no one tells you until it's too late to change. The Rolodex belongs to the bank. Not legally, in most cases, but practically. The client calls the MD's number, which rings your phone. The day you leave, it rings someone else's. The scene. A Wednesday in Zurich, a private dining room on the 2nd floor of a building with no sign. You are across from the CEO of a 1.1 billion euros European industrial company. His company is not yet thinking about a sale. You are here because in 14 months, they will be thinking about it, and when that thought arrives, you want to already be in the room. This is called relationship coverage. It is the strategic work that looks, from the outside, like lunch. He asks about deal flow in his sector. You tell him 3 things that are true, one of which he didn't know, and you tell him in a way that signals you know more than you're saying. This is accurate. You do. Some of it you can't say because it belongs to another client. The CEO files this as discretion. He is right to. The deal that pays your bonus this year is a $1.2 billion leveraged recapitalization. The target company carries the debt. The sponsor takes the distribution. The equity value resets lower. The employees don't know yet. The announcement comes in 6 weeks. You are in Zurich. The rule, access, is the product. Everything you know, every relationship you hold, every piece of market color in your head, it compounds in value only while you are inside the institution that gives you the platform to collect it. You own the relationships now. That is the word everyone uses. Own. You are 43, maybe 45. Your total compensation in a productive year is $2 million, structured across base, cash bonus, and deferred equity that requires you to remain in your seat for it to vest. The vesting schedule is not accidental. Neither is the fact that you know this and stay anyway. The currency is pure revenue, not deal quality, not team morale, not institutional reputation in the abstract. Revenue. Your client book generates or it doesn't, and every MD in the group knows every other MD's number, which means the conversation about who controls which coverage is never fully about strategy. It is always also about who last produced. You have 23 active client relationships. Of those, 7 generate 80% of your revenue. You know this. You spend your time accordingly. The other 16 receive maintenance calls, conference invitations, and the occasional lunch that keeps the relationship current without generating the kind of output that lands on the group head's monthly report. The scene: a boardroom in Abu Dhabi. The Sovereign Fund Committee has 11 members. You speak to 4 of them. The others are present in the way that people are present when their vote is already decided, and they are waiting for the meeting to confirm it. You are presenting a co-investment structure on a $3.4 billion infrastructure transaction. The structure has 19 components. You speak for 22 minutes. They ask 6 questions. 4 are procedural. 2 are the real questions. You answer the real questions directly, without deflection, without caveats. This is what the $3.4 billion buys. Access to a banker who doesn't waste the committee's time. The mandate is approved. The deal closes 9 months later. The project displaces 600 families in a coastal infrastructure corridor. The displacement is documented in an appendix to the environmental impact assessment. The appendix is 212 pages. You have read the executive summary. It describes the displacement as temporary resettlement with full compensation. You have no reason to believe this is false. You don't look for a reason. The rule. The relationship is the asset. The transaction is how the asset pays interest. Your trust circle is now 6 people. 2 are your spouse and your lawyer. The other 4 are people who have seen you in enough rooms to know the difference between what you say and what you mean, and who would not benefit from making that knowledge public. This is not friendship. It is a form of mutual. You manage the MDs. You allocate coverage. You decide which clients the bank prioritizes. This sounds administrative. It is not. Deciding which clients receive coverage is deciding which companies get access to capital. The companies that get access to capital grow, acquire, restructure, and generate returns. The companies that don't get the callback make do with smaller banks, worse terms, or no transaction at all. You are not in the market. You are upstream of it. You are 51. Your compensation package is between $4 million and $6 million depending on the year, the group's performance, and the political situation at the firm level, which is a separate and permanent negotiation. You have 14 MDs reporting to you. 3 are producing. 4 are managing declines with grace. The rest are somewhere in between. The work is now decisions about people, coverage, and positioning 3 things that look different from the outside than they do from this chair. Cutting coverage from a client is not a financial decision alone. It changes which information flows to that company, which affects their strategic options, which affects their employees, their competitors, and the regional economy they sit inside. You don't think about it this way every time. You can't. You'd stop making decisions. The scene: Monday in New York. You are on the phone with a firm in London considering a $2.1 billion hostile acquisition of a competitor. The target's CEO doesn't know this conversation is happening. The target's board will find out in 11 days when the offer is made public. You have information about the target that came to you through a client relationship, information that is not material non-public in any technical sense, but that sharpens your read of the situation. You do not trade on it. This is not virtue. This is understanding where the line sits and staying one step behind it. The rule: information is the actual product. Capital is how information becomes money. Your job is to sit at the intersection. The conversations you have now are about the world, regulation, geopolitics, central bank posture, the governance structures of sovereign wealth funds. You are no longer doing banking in the traditional sense. You are doing something that uses banking as its surface language and means something larger underneath. Your social world is complete. You are not building new relationships. You are managing a fixed set of them with increasing precision. There is no title for this room. The room itself is small. A conference table that seats 8, but today holds 3. No Bloomberg screens. No models running. A phone on the table. Water. You are 58. You run the division. The division generated $2.3 billion in advisory fees last year. You were involved in 11 transactions above $1 billion. In 2 of those transactions, you were the reason the deal happened. Not because of a model or a presentation or a relationship, though all of those existed. Because you picked up the phone and said one thing to one person, and the thing you said was correct, and the person you said it to had the authority to act on it immediately. That is the job now. Not the meetings, not the strategy sessions, the calls, the 6-minute conversation that moves $4.3 billion because both parties trust that what you're telling them has already accounted for what they don't know to ask about. You don't track hours. You don't track deals in the way you used to track deals. You track positions, regulatory posture in 3 jurisdictions, the succession risk at 2 sovereign funds, the political exposure of a family-owned conglomerate in Southeast Asia with $18 billion in assets, and a patriarch who is 77 years old and has not told his board what happens next. You know what happens next. You were in the room when the conversation happened. The room was not a conference room. It was a dinner in a private residence. There were 6 people. 3 governments were affected by what was decided. You do not say any of this in meetings. The meetings are for the information you're willing to share. The person who reviews your performance is the CEO. The review is a conversation. The conversation lasts approximately 30 minutes. You say less than you know. The CEO says less than they know. This is the form of the conversation at every level. But at this level, the gap between what is said and what is known is large enough to contain careers, institutions, and in some cases, policy. Your trust circle is for people. You know everything about each of them. They know everything about you. The 4 of them together possess information about global capital flows, political arrangements, and institutional positioning that would, if published, change the shape of several markets. None of it will be published. That is not cynicism. That is the condition under which the system operates, which is also the condition under which capital moves, which is also the condition under which retirement funds vest and infrastructure gets built and companies get the financing to continue existing. The system is not wrong. The system is the system. You are no longer in the market. The market is a function of decisions made by people like you, which means you are not responding to the market. You are one of the inputs the market responds to. This is not power in the sense that the 22-year-old in the elevator imagines power. It is something quieter, colder, and more permanent. You did not arrive here by being the best analyst, or the best VP, or the best MD. You arrived here by never being the person who made the room uncomfortable, by being the person that the room required. The room has always required this person. It will require one after you. The phone on the table rings. You answer it. The conversation that follows will appear in no filing, no memo, no email chain. It will shape the structure of a transaction that won't be announced for months, which will move a material amount of capital into a market that is currently receiving no coverage, which will create a set of returns for a set of investors who are, at this moment, doing something entirely unrelated to this phone call. You speak. The other person listens. You stop. The other person acts. That is the whole of it. Somewhere in a glass tower in a city that doesn't stop, a 22-year-old steps off an elevator onto a floor that smells like recycled air and dried out ambition. His badge says analyst, first year. The badge has always said that. He has 3 monitors. A Bloomberg terminal he barely knows how to navigate. A model he has been told to check, but not how to check it. He has $87,000 in debt and a signing bonus that felt significant for approximately 1 week. He is here because he wants to be where serious people go, and he has correctly identified this as one of those places. He believes the system rewards the people who work hardest. He believes that the quality of his output will determine the arc of his career. He believes there is a meritocracy operating underneath the politics, and that if he can just get past the politics, the meritocracy will recognize him. He will find out what the system actually rewards. Not today, not this year, but the finding out is already underway, written into the structure of the institution he just joined, encoded in every decision about who gets access to which client, who gets credit for which deal, which relationships belong to the bank and which to the banker, and what happens to the distinction when someone leaves. He will learn the difference between the organizational chart and the hierarchy. He will learn that the hierarchy is who calls whom, at what hour, and whether the call gets answered. He will sit at his desk at AM and feel, for the first time, the shape of something behind the work. He won't be able to name it. He will file the feeling away. In 15 years, if he is still here, he will be able to name it. By then, he won't need to. The terminal blinks. The market opens. The machine takes another step forward. IT was always taking another step forward. It always will.